Hello and welcome to CNBC TV18's Mumbai newsroom. I'm Sumaira Abdi and you're watching MF Corner. Today we're going to be talking about REITs or real estate investment trusts. So REITs are basically, corporations that would own, operate and finance the income producing real estate. In that way, one could say that they are similar to mutual funds, except that in place of stocks, they have a portfolio of rent-generating commercial properties. Joining in to explain the nuances is Mrin Agarwal, Financial Educator and Director at Finsafe India. She's going to tell us what exactly REITs are, how they operate, and who needs to consider investing in them. By the way, Mrin is also a member of SEBI's Advisory Committee on Investor Protection and Education. Mrin, thanks very much for joining in. Congratulations on your appointment. And so today we're talking about REITs. Let's start with, what exactly REITs are. How should we understand them?
Good afternoon, Sumaira, and it's always a pleasure to be on your show. And thank you for your wishes always. Starting with REITs, well, just like you have mutual funds which invest into stocks and bonds, you have real estate investment trusts which basically invest into properties and give returns by way of income distribution, right? So essentially, a REIT is a pooled investment vehicle that owns, operates, and maybe also finances income-producing real estate assets. And these assets could be like, for example, malls. It could, of course, a lot of office properties. It could be hotels. It could be warehouses. It could be medical facilities. So it could be a whole lot of different types of property assets that are available. But the thing to remember, and this is where I think that we have some really good rules on REIT in India, that REITs cannot own vacant land or mortgages, right? So essentially, about 80% needs to be invested into completed and income generating assets, right? And so that's really a good thing because, again, we have seen in the past problems with incomplete properties, right? And even in the commercial space, this problem is not only in the residential space, but even in the commercial space as well. So that's one really good thing, that 80% has to be invested in completed income generating assets. And the balance 20%, of course, can be invested into listed equity. It could be invested into under construction properties. But I think there is a limitation that only 10% can be invested in the under construction properties. There are some restrictions in terms of the exposure that you can have to one property and exposures on the amount of borrowing that you can do. And of course, how do you invest into a REIT as an investor? You can invest through the stock exchange. So just like how you buy stocks, you can go and buy a unit of a REIT. And recently, the minimum amount of investment has been reduced to 10,000 rupees. So all in all, it's a product that is accessible to everybody since the minimum investment is 10,000. And you can invest it through the trading account or through your stock exchange broker.
Okay. But Mrin, how does one make returns? I mean, how does REIT provide returns?
So there are two aspects to the returns that you will get in the REIT. The first is that you're going to get a regular return. And this comes from the fact that most of the investments are in rent-bearing properties. So there is this income distribution. This income distribution could happen quarterly, or it could also happen on a half-yearly basis. Now, here too, there is a rule that says that 90% of the distributable cash flows need to be paid out to the investor. So it's very, very investor-friendly in that sense. The second part of the returns comes from capital appreciation. So while the price of the properties would appreciate for the investor, what you need to track is the movement in the price of the stock of the REIT, or the price of the REIT, I would say, the way it's listed on the exchange. So you have the capital appreciation aspect, and you also have the regular income that is coming in from the REIT.
Okay. In terms of, I mean, you've listed out quite a few of the advantages, but, to sum up and, what is the complete list of advantages for somebody who's looking to invest in REITs?
Well, I think firstly, it's a good instrument to get a regular return, because what happens is that generally you would have an idea that, this is the sort of returns that you can get in terms of the regular return. So there are stable cash flows. Again, if you were to go and invest in a property on your own, right? The outlay that you have is going to be very high, right? You may not have the capital to do that, right? Whereas here, you can start only with 10,000 rupees. Now, again, when you go and buy a property directly, and, honestly, buying commercial property is not at all easy for individuals, right? The other thing is also the liquidity factor, because even if any sort of property that you buy, your money is going to be completely locked in. Whereas over here, it's highly liquid. You can exit from it at any point in time, and hence, it's much better than actually holding the property directly. Now, I think the biggest advantage is the fact that you're getting inflation adjusted returns, because there is a rent escalation clause, as it is there with residential property, with most commercial properties also. Most of the rental agreements are for pretty long term, with rent escalation clauses that have been built in. So due to that, you also have the ability to get inflation adjusted returns. And the returns don't tend to be volatile, right? Because as I said, you have a fair idea on the sort of rental yields in the commercial space, and hence the returns are not that volatile as well. So all in all, I would say low volatility, inflation-adjusted returns, good liquidity, and the ability to get exposure to an asset class with a very low capital allocation.
Okay, but surely, Mrin, there must be some limitations as well, right? Are there disadvantages to this product?
I think the product is at a pretty nascent stage right now in India. I mean, there are only 3 REITs which are available. So what that really means is that, there is lack of long-term return data that's there. I mean, you have return data only for a couple of years right now. I think people also have very limited knowledge, and it's not really a product that, that's being talked about a lot, or, there are a lot of limitations in terms of people knowing exactly how this product is going to work, how is it really going to pan out in the long term, right? So that's what I meant by the limitation of knowledge. Now, mutual funds have been around for 20, 30 years, and people know, how these work. I think where REITs are concerned, it's still a very, very new product. And overall, again, the fees, I think, is still pretty high. So when you look at the management fees of the REIT, it's somewhere in the range of about 2 to 3%. So certainly the fees is going to be much higher than what you're seeing in mutual funds, for example.
Okay. What would people need to consider when they're looking at investing into REITs, right? What would be the possible, 3, 4 main things to know?
Yeah, I mean, there are quite a few things. And this is where also I feel that, investors might feel a little limited, because to kind of get all of this information together may be a little difficult for them. But of course, the first thing to look at is what is the sort of distribution yield that the product or the REIT has given. So this means what has been the payout in the near-term period. So when you look at the last financial year, the payouts have been in the range of about 5.5% to 6% per annum, right? So this gives you an idea about what the returns are at this point in time. And the second thing, very importantly, is to also check the weighted average lease expiry. So this basically tells you the time left for the property to go vacant. It's typically, I think, right now in the range of about 7 years. And obviously, the higher, the better. And this basically shows you, the cash flow generation capability as well, because it tells you that, that the space has been occupied for the next 7 years. So you're pretty sure that, okay, that means that there is going to be cash flow generation capability as well. There are many other qualitative factors that you need to look at. For example, the portfolio quality of the REIT. So, for example, what are the sort of properties that are held? Is it office space? Is it malls? Is it hotels? Is it residential? Obviously, residential is not really very desirable because the rental yields on residential real estate are much lower than that in commercial properties. The second aspect is to see what are the sort of tenants that are there in this property. Is it Fortune 500 companies? Is it MNCs, global IT firms? What sort of companies have rented out this space? Of course, what is the sector diversification of the tenants as well? So typically, again, you would find in most of the REITs customers coming from technology, from the banking and financial services, consulting space, etc. And again, you would also want to look at what is the sort of concentration that is there. So for example, in any REIT, you would want to see that the top 10% of clients, what is the sort of concentration? Obviously, you don't want to get into a REIT which is highly concentrated to, let's say, the top 10 clients, or it is concentrated in one geography. So obviously, you need to look at the geographical spread as well. Typically, you would find at present that it would be spread across the metros and, of course, then cities like Bangalore and Pune and Hyderabad. But yes, so you are looking at a diversification among geography, among clients, and the sort of quality of clients that are actually leasing these spaces.
Okay. Mrin, we're going to take a very quick break now, but when we come back, we're going to continue this chat on REITs. We'll find out what's the taxation structure, what has been the performance, and whether, you as an investor really need it in your portfolio. All of that is lined up next. Stay tuned. Hi, welcome back. With us, we have our expert, Mrin Agarwal, who's a financial educator and director at Finsafe India. And today we're talking about REITs, the various advantages, disadvantages, and basically what kind of a place does it have in your portfolio. So we've spoken about many of these aspects. Now to come to taxation, Mrin, how's it taxed?
Well, the taxation is kind of a little complicated because it depends on what has been the distribution in what form. So there are different forms in which you can get the distribution. You have interest, you have dividend, and you have the repayment of capital. So very quickly, repayment of capital is going to be tax-free, of course. Interest is fully taxable at the slab of the investor. And as far as dividends are concerned, they're going to be tax-free if the company has not opted for concessional rate of taxation. But if company, for example, has opted for a lower rate of taxation, then the dividend is going to be taxable. So what is very important is that, and of course, you will be able to get all of this information from the REIT in terms of what's been the payout due to interest, what's been the payout due to dividend, and what's been the capital repayment as well.
Okay. But Mrin, what has been the kind of performance, or rather, what kind of returns have REITs given?
Okay, and I also forgot to mention that there's going to be capital gains. So when you exit the REIT, so when you sell the REIT on the exchange, just like how you have capital gains in equities, there is going to be capital gains here as well. So the way it works is that if you exit before 3 years, it's 15%. And if you exit after 3 years, then it is taxed similarly to equities. Now, in terms of returns, you're seeing the distribution yield in the range of about 5.5% to 6% on a pre-tax basis. This is for the last financial year that I'm talking. When we look at the capital appreciation, and I think the capital appreciation has been pretty good, because when you look at it from inception, the capital appreciation is in the range of about 12 to 18% CAGR, which I think is pretty good. And again, we are seeing good occupancy rates as well, between 85 to 90% occupancy rates as well. So I think all in all, it's pretty good. And, again, when you look at post-tax returns, you will find one of the REITs that I saw, for example, has pretty much 90% return as a tax-free return, because that's what they have returned in form of dividends. And, so one must, of course, look at this proportion very, very carefully in terms of how much is coming as dividend and how much is coming as interest.
Okay. But Mrin, if somebody wants real estate exposure, and I'm not talking about physical real estate, right? Say you're investing in a real estate stock, which is what mutual funds do. You can have a thematic mutual fund. Why would somebody want to consider investing in REITs over mutual funds?
I think, it's a product that can complement a mutual fund because it gives you diversification from debt and equity. It gives you a regular income as well. And I think that's one of the biggest advantages of this product, that it gives you a pretty stable, regular income. Of course, it's going to be less volatile, so it's not linked to the equity markets at all, right? So it's going to be less volatile as well. And, these would be reasons that, people could look at this as a diversification along with your mutual funds.
Okay. So, Mrin, what kind of an investor would need to have REITs in their portfolio?
Well, actually, I have been telling people who want regular income, like, for example, senior citizens, I have been asking them to put a little bit of their money in REITs as well, because of the regular income component that's coming in. And again, when you look at it over the years, this 5.5% to 6.5% sort of regular income that's coming in from the REIT has been pretty constant. And I would actually expect it to go up further now from here, because of the fact that certainly the commercial markets have opened up a lot. People are getting back to work. There are more and more companies who are setting up in, for example, in places like Bangalore and Pune, right? So I would say that certainly this is a good product that should be looked at by people who want regular income. At the same time, I think it's a good product for anybody, because looking at the capital appreciation on this particular product, I think it's a great product to just put some amount of money. The only thing that I would caution is that right now, check it out, because again, as I said, we don't have long-term history in India. So, we haven't seen what could go wrong with this at this point in time, right? And so what I would say is that certainly allocate some amount of capital, check out how the product works out for you. But yes, I do think that there is a place for it in people's portfolio over physical real estate as well.
Okay. But Mrin, like you mentioned, over physical real estate as well, there is a place. But, most of us are already, most Indian portfolios are already overweight real estate, right? So therefore, if somebody is looking to add on REITs on top of that, what is a recommended allocation? Like you mentioned, for example, senior citizens. What kind of portfolio can be allocated to this?
Maybe again about 5 to 10% at the most. The reason that I'm saying this is that if you're able to generate a 5% post-tax return from this, it's not a bad return considering what you're getting in fixed deposits, right? So, and in any case, if you want that regular returns, I don't think that debt funds are an option. So I would say certainly maybe 5 to 10% of the portfolio for people who want that regular return.
Okay. The other thing is that, when we talk about mutual funds, it's we say buyer beware, right? If you have invested, you must also follow through by monitoring the portfolio, etc. Now, how to recognize a possible red flag in REITs, right? If suppose one was to say that, monitor the portfolio, how would one even monitor a portfolio which could be, geographically totally separated from you?
Yes, and I think this is one of the biggest challenges that a retail investor is going to have, because you are completely dependent upon the information that's being provided on a quarterly basis, of course, by the REIT. But I think it's, and that's why I would say that first thing is go for a REIT that's really well diversified. So even if you're seeing a REIT which is maybe giving a higher distribution, but which is geographically, let's say, concentrated in terms of the tenants, maybe, you might want to skip that and go in for a REIT which is more diversified in nature. But yes, I think, some of these challenges do exist for investors.
But Mrin, if as of now, it does look like there are quite a few advantages. Why then are we not seeing the introduction of more REITs?
Yeah, I don't know. It could be maybe due to, some of the net worth requirements and stuff like that that's there. And also, I think a lot of investor interest needs to pick up in this product. We do get quite a few queries about it, but I think people are still very unsure as to how this works and stuff like that. And then, of course, there are other investments that are available, let's say, which are giving maybe better returns. So maybe people tend to also not look at the capital appreciation aspect of it. Everybody focuses only on the distribution aspect. And that's where, maybe some investors are missing out because of this.
Yeah, actually, the whole point of doing this show was because we had received quite a few queries on people wanting to know about REITs. So, like you rightly put, that maybe there just isn't enough awareness yet. And I guess that's what we're trying to do. Mrin, thanks very much for joining in and for explaining this concept and also trying to put it in perspective in terms of, how it can practically be a part of your portfolio and whether it should at all. With that, we'll wind up on MF Corner. Thanks very much for watching. The team of Closing Bell joins you next.